Welcome to the Everyday Investor. Today, if you were debt-free right now, could you actually afford to live off of $400 to $500 per week? About 40% of people aged 65 and over right now in New Zealand have virtually no other income besides New Zealand's superannuation. If you've become or you're on track to becoming mortgage-free at time of retirement, especially from your after-tax income, it's a great achievement, but that might not be good enough to set you up for retirement. $400 to $500 per week after rates, insurance, maintenance, food, you get the idea. There has to be a better way though, right? You shouldn't have to choose between the money or the home. In France, they have this concept known as viager. Instead of debt, as in the case of reverse mortgages, retirees can instead sell a portion of their home for regular payments. These payments known as rente viager. It all sounds really awesome, right? But do we actually have anything like this in New Zealand? Well, you're about to find out today. I am speaking with the one and only Ralph Stewart today. Ralph is the founder and managing director of Lifetime Retirement Income, business with over $1 billion in funds under management. He's the former CEO of AXA Insurance and the former CEO of the Accident Compensation Corporation. I hope you enjoy this one today. You're listening into the Everyday Investor Podcast, and I'm your host and financial advisor, Darcy Ungaro. In this podcast, I'll cover anything that can be useful for building new wealth in the new world. I don't mind if you have a lot or a little in your head or in your wallet. Learn with me how to be a better everyday investor. Check out the notes for articles, special deals, referral links, and to sign up to the free fortnightly newsletter. If you enjoyed this today, please leave a 5-star review, and most importantly, keep in mind that today can't be considered personalized financial advice. If you need that, reach out to me or contact your current financial advisor for input. Let's make a start. So imagine this. You work your butt off for 30 to 40 years in your job to get rid of that mortgage. And then when you finally get rid of it, you realize you've got another problem. All of your wealth, all of your resource has been piled in to an illiquid, non-divisible piece of real estate. You're over 65 years old. All of your wealth is tied up into your home. You are the classic equity-rich but cash-poor punter. What do? Your options are kind of limited right now. You could get a reverse mortgage, but with those variable interest rates, how long will that actually last before all that equity is gobbled up? You could sell the property, but you like the property. You've worked really hard to be there. Why do you want to get rid of it so soon? That's where we need another solution. So today I'm catching up with Ralph Stewart.
Hi, Darcy. Thank you for having me.
Thanks for coming up again. I think it's been 6 years since we caught up a long time ago, right?
Gosh, has it been 6 years?
I think so. Yeah, I was watching the episode yesterday on my way home from work, and it was actually quite good. I was thinking, man, this is a really good podcast. I should listen to it more often. It was good, but things have changed since then in terms of what you're offering us. So for our audience, just so that they understand what you do and what Lifetime Retirement Income is all about, do you want to just give us the headline there?
Very quick.
Yeah.
Our purpose has not changed. So providing retirement income to retirees is what we're all about. And started 10 years ago and love it. One of the products we started with was a guaranteed income product called a variable annuity, used a lot in North America. We still provide a regular income for life. It's just no longer guaranteed. Lower interest rates, the impact of COVID, market forces made it hard for that to be economic in the New Zealand context.
Because that was like an insured annuity, right?
Correct.
Where you would put some money into a special black box. It would be invested in a way that ensured that you'd have a return, but just in case you lived longer than your money would allow, it kept on going, right?
Correct. In simple terms, we used to call it mortality insurance.
Mortality insurance.
If you lived long, it was on us.
Yeah.
But the effective cost of that insurance just got prohibitive.
Got it. So you shut that down. Okay. So I want to kind of explore what some of the other solutions are and what some of the developments are that you guys have brought to the table recently. But before we get into that, what is the problem that you're effectively trying to solve?
The number of practical options to the retirement community to turn a capital sum into a regular income they can rely on for 30 years is just so few in New Zealand. I mean, a problem statement is about giving people more choice. Pretty much term deposits, drawdowns from KiwiSaver in the future, drawdowns from managed funds perhaps. After that, you might know some more, I'm not sure.
Right, but it all comes down to the house, if they have a house.
And there's the house as well.
Yeah.
But that's sort of just emerging. Effective ways of spreading capital over long periods of time. When you stop saving and start spending, it's a different space.
Sure.
And the house is just beginning to emerge into that equation now.
Okay. So what are some of the current ways that a house would help retirees fund their retirement without selling it?
It's relatively new in New Zealand, and relatively kind of new in the world. It's sort of a concept of about 40 or 50 years. So releasing equity from your home, the most common way to do that is to buy a reverse mortgage. And a reverse mortgage is a pretty simple tool. You simply borrow some money using a house as security, and when you sell that house, you repay the loan. And more New Zealanders will be doing that. It began here about 30 years in Wellington with a life insurance company called Invincible Life. It was followed not long after by a company called Sentinel, which was started by the originators of Sovereign Insurance when they sold to ASB.
That's right.
Then Sentinel was ultimately sold to Heartland. And in New Zealand today, the marketplace is almost a monopoly. Market share for a reverse mortgage using debt is about 80% Heartland, about 10% SBS, and a number of small providers after that.
Okay, so there's more than two providers, but it's really just Heartland.
Totally. Heartland, SBS, and a couple of the banks will stand behind it, but not very far.
Right. And the challenge with, well, there's a lot of challenges, I guess, with reverse mortgages. Firstly, it's that name. People work their butts off to get rid of their mortgage.
Yes.
They finally accomplish that massive goal, expecting you get basket from the bank, never comes. But they get rid of that mortgage, and then to survive in retirement, they got to turn their back on that attitude that got them there. Get rid of debt. Debt is bad. And that's really hard for retirees, right? But it's also like uncertain because of the interest rate that can change, right?
Correct. Head of marketing and member of our leadership, Chelsea. Chelsea and I did a number of focus groups, not statistically significant. We did about 15 in total up and down New Zealand. There were two groups, those that had a current reverse mortgage and those that were thinking about it. And we just sat and asked them, what's going on in this space? The first common denominator was whether you had a reverse mortgage or you didn't. Both groups didn't understand it. Mm-hmm. So the communication process and the understanding was really, really low.
So are you saying even those that had a reverse mortgage didn't really understand it?
Correct. The notion of a variable rate of interest and a variable impact on your equity was lost on about half, I would say.
Wow. Okay.
So that was the first point noting for us is whatever we do, got to find a way to communicate this really well and make it clear and understood. Second thing that came up as an objection to reverse mortgages, as you call out, Darcy, was the uncertainty factor. If I've got a variable rate and I borrow some money and I'm not sure where I'm going to pay it back, I have no idea how much equity in my home I'll retain. The bank's kind enough to tell you that it'll never be greater than zero. You'll never lose more than your house, but you might lose all of it. And that really scared people. People were really concerned about that. And third element we picked up was, retirement sort of goes through, if you will, kind of phases as we age. Our ability to behave in retirement changes as we age. So the clear message we got is whatever solution the house is used to help provide an income or capital, it needs to be flexible. And a debt-based instrument doesn't make that particularly easy. So Chelsea and I landed on three challenges. One was, how can we make it simple and understandable? How can we make it reliable and consistent and certain? And thirdly, how can it be structured in such a way that it can change through people's retirement lives?
Anything in financial services is hard to understand. And I think when you're involved in this industry, it's like you can take for granted what you've already learned and just assume that everybody else can understand it really, really easily, almost as fast as you can explain it. But when you're dealing not only with people who haven't heard of the concept for the first time, but people who've kind of been maybe out of the workforce for a while, and not to say that they're daft, but they haven't been reviewing things like this for a long time. And so you're trying to bring to the party something quite foreign to them, right?
Oh, completely, Darcy. In retirement space, whether it's the use of the home or the use of capital, communicating effectively, and clearly is the challenge, mate. Yeah. It really is. So people totally understand. There's quite a few studies about, changes in cognitive recognition as you age. It's very real. Yeah. You've got to find clear communication methods. Totally.
Right. And that floating interest rate, which is what it usually is, right, with these reverse mortgages, is an unlimited risk corridor, really, where we kind of thought, I know last time we were catching up, we were probably talking and lamenting about how the interest rates were so low, right?
Yeah, exactly.
And they were never going up. And that was almost like a dangerous assumption, but it was true for so long that it was easy to make that assumption. Now we've been reminded that interest rates can indeed go up, which ironically makes term deposit investors probably pretty happy.
Great.
But when it comes to reverse mortgages, that's an unlimited corridor of risk where now you have this compounding effect of this capitalization of interest that's kind of ballooning way faster. And that's a massive, massive concern for people that are
totally, Darcy.
That need certainty.
That's the killer point. We started looking at this 4 years ago. We did our first focus groups.
Right.
At that time, the Heartland rate was, I think, 575 or 625. As recently as 3 months ago, it was 10.5.
Wow.
So if you were betting on having perhaps 70% of your equity retained at 6%, it could fall to 40 at 10.
Yeah. And the relevance of that is the rule of 72, right?
Sounds.
You take 72, you divide it by, say, 10%.
I understand.
And now you know that, like, if you borrowed, say, $100,000 from a reverse mortgage, in 7 years, that's going to be $200,000.
100%. Exactly.
Which is that, yeah, I get it. Okay. And then the flexibility concern. And I know there's been some innovation here around having regular incomes and then having almost like a de facto revolving line of credit that retirees can draw down on with their reverse mortgage facilities. So it's not completely inflexible, but there is that concern as well that it can't adapt as people's spending patterns change as they get older, right?
Agreed. And the ability to be able to tell somebody or an older person that, listen, in 10 years' time, you'll own 65% of your house, requires the provider of that service to take some risk.
Sure.
Because house prices won't fall.
Exactly.
And that's not the business of banks. Banks are using the home as security. The loan will be whatever it is when the house is sold.
Right. Yeah.
Quite an important difference between the two methods.
Yeah. Hey, I'm sorry to interrupt this one, but I'd like to share with you the idea of a poor man's reverse mortgage. There's a noble way of getting rid of the mortgage by retirement, and then there's the smart way. The smart way involves repaying your mortgage early by using a special type of mortgage product called a revolving line of credit. There's a few steps involved, and I'm going to gloss over a lot of the detail, but just give you 4 of these steps right now. Number 1, start with an amount of money that you could pay on your mortgage, which is more than the minimum amount that you have to pay. Hopefully that's a positive number. Number 2, multiply that amount by a period of time, for example, 2 years. Step 3, restructure your mortgage to include a revolving line of credit with a balance that you could repay inside of 2 years. Next step, restructure your current mortgage to split off some of it, put it on a revolving line of credit, and then repay that balance inside of 2 years. You should get that balance down to 0 within 2 years if you've done this right. And lastly, step 4, every 2 years, you split off a new chunk from your fixed rate and you allocate it to another revolving line of credit facility, or you increase the limit and balance of the existing revolving line of credit facility, and you do it again. Now, there is a lot of detail that I'm missing out here, but over time, the idea is to end up with a big revolving line of credit limit that can be accessed in retirement because you've paid off the balance in full. The poor man's mortgage solution allows you to split off chunks of this and fix it as time goes on, so it's a cheaper interest rate. Now, this is not for everybody, and the bank's lending criteria applies, so not everybody can gain access to this. But if you are a subscriber to the fortnightly newsletter, you'll see a little button there to book in a refinance session if you want me to personally walk through the process of setting this up for you. That's it, though, for this ad. I hope you are enjoying the podcast. Let's get back to it. So when people get to this point where they're debt-free, perhaps, on their home, let's assume they're debt-free, and they recognize that government superannuation isn't enough to get them through, what is the typical way that people start to work on this problem? Like, they obviously worry about it, I would imagine, and then they would take a step. What would be the first step beyond worry that most retirees take when they recognize that they have an income or a cash flow problem?
Got it. Because we are a retirement income company, we became aware of the issue because existing customers and prospective customers said to us, if I'm an existing customer, I'd like some more income, but I'm out of, could I use my home? And for prospective customers, we were hearing that we'd like some more income, but we don't have any savings. We only have our home. So the notion of applying a retirement income approach to equity release is quite new.
Yeah.
And in our space, it only relates to an income. Other people who are using equity release for lump sums. And their needs quite different. It might be for a bucket list event, repairs to the house, new cars, those sorts of things. We brought to the market a solution that really is for a retirement income. It's paid every fortnight and super juiced it.
Okay, so break it down. So we're talking about an income that can be created through the equity in your home.
Correct.
So how does that actually work? What are the mechanics?
So just to go backwards a little bit. So the debt model is pretty simple. You borrow some money, use your house as security, and when you decide to sell your house, you repay the loan and you don't know what the loan balance will be.
Right.
So when we did our focus groups, we identified perhaps a better way to do that. And we found in Europe, they use a different model. And it's called a credit model.
The credit model, okay.
So we don't lend any money to the homeowner at all. What we do is we buy a small stake in the house every year for a period of time. So to your good point, Darcy, if we use, say, $1 million, minimum age for the couple living in the house has to be 70, could be older. So let's say the house is $1 million, we'll pay them $25,000 a year, less some fees and expenses, which comes to a net of $22,700.
Okay.
Every year, paid every fortnight for 10 years. And at the end of the 10-year period, we'll have paid them $250,000 less fees and taxes, or fees I should say.
Yes.
And in exchange for the $250,000 we paid, they've given us 35% of their home.
Or $350,000. This $1 million property, the homeowner is selling basically 35% of the property for 25%, which is spread out over 10 years.
Correct.
And you touched on something that I probably should clarify massively, because I think this is huge. There's fees, obviously.
Yes.
But I guess one of the fees is that you are taking more than what you're given, because you're buying 35%, or you're getting 35%.
Correct, Darcy.
But tax, they're not actually receiving an income, right? Like they're actually...
Correct.
Well, they are receiving an income for all
Correct.
purposes, but they've actually sold an asset.
So you're right, they're selling capital.
Yeah.
So it's not taxable.
So if it was say, whatever the number is, like $200 a week that's coming in to supplement their government superannuation, it's the equivalent of them maybe earning $250 a week.
Sounds
I'm
exactly
butchering these numbers.
No, exactly.
But that's quite important, I think, because if it was a traditional investment product that they were earning interest on, say it was a managed fund, and they're paying tax as their fund is growing, gaining investment returns. They're not paying tax as they're drawing down on the fund, of course, but it's an important distinction because it is fairly tax efficient, unless I'm missing something.
You did right. They're selling a capital asset that they've owned for a long time, which in New Zealand still is not taxable. I don't think it ever will be when they're the owner occupiers.
Sure.
They're not investment properties.
Yeah. Okay. And so this is new in New Zealand, but this happens overseas, right?
The debt model
has
been here for a while. Call it nearly 30 years. We've just brought to market the equity model in the last 2 months.
I see. Okay, so the debt model that you're referring to is reverse mortgages.
Correct.
And the credit model is the shared equity, which is very it's risk sharing rather than risk transference.
100%.
Which then leads me to think about things like the Abrahamic faiths and how effectively this would be a lot more tolerable for those that don't believe in interest.
That's very true.
Have you had that feedback yet?
I often thought about that, and that's a really good point. It's the next thing for us to think about because there are a couple of stakeholders here. They're the homeowners themselves, husband, wife, or whoever they may be, and the next sort of 10 years of their life getting an enhanced into super income, enhanced by raising some equity.
Yeah.
And then there are providers of capital that make that happen.
Exactly.
So instead of charging interest, they're getting a 25-35 benefit.
That's massive.
So that potential for investors that can't take interest is very real, Darcy. Very real.
Well, even on both sides of it, right? So a lot of people wouldn't believe in borrowing at all.
Yes.
And so this kind of takes care of it because they're selling the property, which they're going to do anyway. This is the biggest kind of thing that I often struggle with is explaining to people that you cannot bring your wealth with you when you're dead. And it sounds really basic and kind of almost like forced, stupid, but it really is an assumption that we're not necessarily, it's not carried in our consciousness.
Yes.
It's very deep down inside this belief that investing is such an important game to win that you need to die with a lot of resource, potentially to give to kids who don't appreciate it.
Yeah.
But that seems to be a lot of the default modus operandi of a lot of retirees is that they have to die with a lot of a resource. And when they realize they can't take it with them, which I know everyone knows that intellectually, they don't really believe it though. They know that they have to sell it, and therefore, why not sell it sooner, or sell a bit of it sooner, so that at least they can enhance their life while they're alive, rather than suffer, scrimp, and save so that the grateful generation gets it, right?
Totally. It's a point of difference between, the debt model, the credit model, or the equity model. Is under the debt model, the family also share the uncertainty. It's unclear how much will be left for them. Under the credit model, if it's 65% after 10 years, they know they have 65%. So that certainty flows through from the individual home occupiers to the family.
Okay. 70 years old. What happens if, so even just yesterday I was talking to a couple who was 80 years old and 65 years old, right? 15-year difference. How does that work when there's an age gap?
Got it. There's a wee bit of practical math, which I know you'll eat. Our minimum age is 70 because we have to have a little bit of a view on mortality.
Sure.
So that we can repay the providers of capital and let someone else have a turn. So minimum age is 70. Might be 75, 76, or even greater than 80 for 10 years.
Yes.
After 10 years, we might renew and buy some more of the house for another 5 years.
Right.
So for most people, that's the majority of New Zealand mortality covered. If you were 70, it takes you to 85.
I see. Okay. But definitely no exceptions. If one member of that partnership is below the age of 70, you're not getting on board this train.
Correct. We have to have, with a sensible degree of probability, some handle on when people will repay.
Got it.
Because they live in the house for as long as they like.
Right. If they had a reverse mortgage before they come to this product, again, they would be excluded as well. They have to have a debt-free home.
Sound.
Right. Okay. Great. So it has to be a debt-free home. No one can be under the age of 70. It'll go for 10 years, maybe another 5 years beyond that.
Correct.
And in exchange for more equity, of course.
Correct. We go to 50%.
You go to 50%.
55 to 50.
Okay. Let's flip it around then and talk about what it looks like on the investment side. So the first thing that came to my mind was this probably isn't a retail opportunity for investors.
Correct.
Okay. So you would have investors who are parting with their capital for a 10-year block of time. Is it done like that, or is it all pulled together?
It put to the wholesale investors, as you call out, Darcy, is at least 10 years.
Okay.
If you use the mortality tables and we make some assessments about people's lifestyles when they move into retired villages or just downsize, etc., we think if everybody was 70, that all have repaid after about 12 and a half years.
Okay, on average.
On average.
Okay, and that's how you build that model.
Yeah.
Okay. But someone who's looking for an alternative investment, or somebody who doesn't want to make money from interest, which is, I think, a growing number of people who want that. They want a risk-shared model when they're getting a return.
Yeah.
This is an interesting opportunity for them, right? Is it somewhere where it will go where it will either become a retail offering or it would become some sort of closed family offering where maybe the kids who are income rich but equity poor could actually be part of the investors or part of the funders of the income?
Got it. We see the funders as being, wholesale investors initially who can, basically match assets and liabilities.
Yeah.
So take a Kiwi sale fund, for example, with a weighted average age of 38. A 10 to 15-year asset that's linked to residential property that behaves like equity, so there's equity-type returns with bond-type volatility, is a good opportunity. And that's where we're marketing ourselves to. Later on, to give younger people access to residential property early in their lives, we might go retail, but it's probably a year away.
Okay. Grease the rails first, make sure everything's working well.
Yeah.
NZ's, like the NZ Super Fund, ACC, is that kind of the institutional type of money that you would expect to come into this, or are we talking about high net worth individuals? Who's going to be investing in this?
It's a bit of a hobby horse. ACC and NZ Super would be fabulous for this opportunity. And pretty good dialogue, mate. Sensible dialogue. But Chelsea and the team at Lifetime, we just couldn't originate fast enough for us to be significant enough to them. We're working towards our first sort of 80 houses, then 300 after that. For this to be meaningful for ACC or NZ Super, you'd be talking 3,000.
Sure.
So it's a one day.
Yeah.
One day, Darcy, but
yeah,
probably 10 years away. So the sort of investors we're seeing are, for example, KiwiSavers, who have a very small portion of their total KiwiSaver investment in unlisted securities and alternatives. And we're arguing residential property is a great alternative.
It is, because it's not hard right now, I guess, to invest in listed commercial property. That's kind of like, if you want to invest in property, that seems to be where most people go. But the avenue to invest in residential property, well, best that you could do is get a proxy for like investing in retirement villages, like possibly listed companies, right? Whereas with this, I guess, if you were a smaller KiwiSaver provider, and it's
obviously we've shadowed the regulator, the Financial Markets Authority, as we've done this and analysed the returns together. And over 30 years, residential properties delivered about 7% per year. Over 10-year rolling periods, it looks more like 4 to 5. But they're pretty reliable returns. In a volatility window, which is about half that of an equity, that would be similar. So for a wholesale investor, good asset.
And so what kind of returns would they be expecting reasonably if they did something like this?
There are 3 components to the returns. So the first is they're buying an asset for 25 cents and getting 35 cents worth of equity. So there's some uplift there, which we do an IRR and just calculate and put that into the unit price over 10 years.
Okay.
Feed that in. Then there's what the property does itself as a unique investment in the portfolio of properties.
Right.
So add the 25, 35, and we use in our evaluations 5.75.
In terms of the capital appreciation over time? Okay.
And there's a wee bit of an odd nuance. Is because of the way GST works in New Zealand, you can actually claim back the GST as you go along and then pay it when the house is sold. So there's actually some positive carry from the government.
Wow. Don't say that too loudly.
No, indeed. Quite right.
But close that loop first.
Quite right, mate. So to answer your question, let's assume we're right. And the actual returns on residential property over a 10-year period are 5 to 6 or something like that. And the investor stays for 10 years. The return after tax and fees was somewhere between 11 and 13.
Right. Wow. And on the other side of that, when we're thinking about the risk is, well, the first thing I think of is liquidity, right? So is there going to be some sort of restrictions around when they could penalties?
Very good. That's why it has to be wholesale first.
Sure.
It can only be a very small portion of a KiwiSaver, probably less than 0.5%.
Right.
Because they're unlikely to have a liquidity option for at least 5 to 7 years.
I see. Okay. All right. So it's kind of like, well, to really butcher this example, it would be kind of like getting a 5-year term deposit, and within, if you cash it in early, you're not going to get any return.
Exactly.
Okay. But in this case, you just might not be able at all to get your capital out.
You get a return, but what we do is we prioritize redemptions.
Sure. Okay.
So present the wholesale opportunity as being for long term. If situation changes and you need some money back early for any reason, we'll prioritize your redemption in the process.
Okay.
But acknowledging you're defeating the original purpose.
Yeah.
When it's long term.
Yeah. And I think there's the head and the heart, right? Where a lot of investors kind of, of course I'm a high risk investor. I can part with this capital for 10 years, but then somebody's getting married. They got to cash it in, or whatever the story is, right? What is the potential size of the market that you're addressing here?
Oh, Darcy.
Because you like, in my mind anyway, you're the only one really that's operating specifically in this space. I know like branded that way, right?
Correct. Kind of a couple of ways of looking at that. If you look at it from a funds management perspective, this mighty KiwiSaver engine, $100 billion, you'd probably start there and say that all of that is going to become possible retirement income money. The demographics and population in New Zealand, look out, 10 years at a minimum, as a maximum, and think about 1,250,000 people, almost a third of the population. It's huge.
It is massive. Because basically anybody who's going through life right now with a mortgage and maybe building up KiwiSaver, as soon as those numbers start to equalize, they're debt-free at time of retirement, which means that, well, they've achieved a goal. Well done. You can pay off your mortgage with the KiwiSaver balance, but now you have another problem. You don't have enough money to live in your debt-free property.
100%.
I guess the only issue is that KiwiSaver, you can pull that out at age 65 at the moment, but then you have this awkward 5-year gap. So what about that then? How would people get from, say, being mortgage free at age 65 what's there for them in terms of their options? What would you expect the typical retiree to do before they come to you, knowing that they have to be debt-free before they buy that product?
The trend we're seeing, quite clear trend, in the last 10 years is that while 65 is notional in terms of being debt super, it's not the actual evidence of behaviour. We're seeing people stay in the workforce for longer and longer and longer. So the retirees that we're finding are new retirees are closer to 69.
Yeah.
So they're working for longer, reducing debt for a longer period of time, and are closer to being debt-free. Having said that, though, the other clear trend is people are going to retirement at greater numbers with more debt. And that's why there is a place, for the reverse mortgage using debt, because they could swap that out and just swap the term they pay their debt until they sell the house. And that's very fair and practical.
Yeah, or just keep a revolving line of credit from the traditional bank.
Totally.
Yeah. Okay, and so security type. So with any, even with a normal bank mortgage, with a reverse bank mortgage, the lender is going to be looking at that property, the collateral, to secure the debt that they provide. With an equity sharing sort of situation, I imagine it's no different. So you're going to be looking for properties that are more than likely to succeed in terms of capital growth, I would assume.
This is probably the hardest thing we struggle with. I see.
How do you be fair, right? Or how do you be profitable and fair at the same time?
Totally nice. In the banking environment, the term that you'll be familiar with is the LVR. So by and large, for this sort of thing, the LVR of someone at age around 70 might be 25%. So for that $1 million, the bank will lend you $250, and no more. Pretty safe bet for the bank, really. That'll be okay. For us, we're going to buy 35% of that house over 10 years based on the opening value of the home.
Right.
And then we're going to value that for 10 years as it goes through. So we are way more sensitive to the bank, to the property value, because we have an interest in it. It's only security for the bank.
Right.
So we rely very heavily on independent, registered valuations.
Right.
And fairness through that process. Albeit, properties are different. We're learning that registered valuations of themselves are more of an art than a science.
Dartboard, yeah.
Down.
So at the moment, if you were required to get a valuation report to get a mortgage, you're going to go through an independent valuation ordering service. Is that kind of what you would do as well, like using Velocity or something like that?
Yes. Yes, the Velocity panel's fine. To date, we obviously asked the homeowner, but do you prefer what's best for you?
Okay.
And to date, they've identified their own.
Oh, okay.
No one's asked us for a reference yet, I don't think.
Okay, so people could actually appoint their own valuer to do the job at the moment.
As long as they're registered in New Zealand as a registered independent valuer.
Okay, so that's okay. But will there be situations where you'll look at an applicant and you'll just say, no, there's no way, because you own a property which you don't even have code compliance on this property, for example, or it's too unique where there's a commercial element, we can't sell it. Yeah.
Exactly, Darcy. It's been pretty brisk already, with only sort of eight weeks under our belt. Chelsea will know the numbers better than I do, but about 100 applications, 15 we've had to not proceed with because there's been debt on the property, or it's been an apartment where there's actually no land particularly involved.
So with those applications that have come in so far, you mentioned that you're speaking to a broad community of retirees already with your pre-existing product set. How curated are these applications? Are financial advisors often involved, or is it typically, say, a lawyer or an accountant or even a family member that are holding the hand of the customers here?
It is early days. We try and, as much as we can, promote financial advice, because if we can do that, we can't do financial advice, but we can do financial modelling for people. We can identify right at the outset, is this a debt model or a credit model, and look at both. Make sure that they get the right answer for themselves. One of that 100 odd that came through was a lovely person, and when we did the analysis, she's actually an existing customer of Lifetime. Because of what she wanted in her life, a lump sum to do some things, and her age, the debt model was better. So we're able to tell her that. And it's better perhaps that a financial advisor does that than us. So we promote financial advice early in the process. We won't enter into agreement unless they have legal sign-off.
So it's kind of, because I imagine the journey and the older you are, depending on where you come from, I know it was different, it's going to be a bit of a journey to get to that space where you're comfortable with this idea.
Yeah, exactly.
But I think what I like about it so far, unless I'm misunderstanding this, is that you can't, well, right now anyway, you can't sell a portion of your home. You can take out a reverse mortgage, yes, but that's a debt product. But you can't just sell a portion of your home. It's not fractionalized.
Great.
So this is as close as you can get by introducing another owner. So effectively what happens is you would have lifetime retirement income, or the custodian, I guess, would appear on the title. Is that right?
Trying to be as unoffensive as possible. And people are sensitive about their titles. And, I think we all would be. A house is such a big asset.
Yeah.
So we place a caveat on the title.
Oh, right.
We're not named on the caveat. Okay. It just means that if they want to do anything with the house, they have to tell us first.
Yeah. So now I'm just thinking, like, going in forward maybe 10, 15 years in the future where this potentially becomes a little bit more common. What has been locked up is now set free. In other words, the equity that has been dormant in people's properties is now able to be accessed using products which aren't as offensive as they once were.
Sound.
Therefore, there's more money that will be injected into the economy as a result from the demographic that normally wouldn't spend money. So normally you would see a lot of frugality.
Oh, too good, Darcy.
Not a choice, but potentially just they have no choice. They have no money, right? But I wonder how that will impact things in terms of products and services and general economic activity that could occur within that generation.
Well, it's
speculating massively, but
I mean, for us being selfish, we just hope it leads to a bigger proportion of retirees have better retirement lives.
Yeah.
The $1 million house example, if NZ Super's $32,000 a year and we're paying $22,700, damn near doubles it.
Yeah. It's kind of like being on $70,000 a year in retirement when you adjust it for tax, right? Ish. If you don't have to make mortgage payments, that's 100% pretty good. So the only kind of issue here that I can see is that there's still going to be a situation where there's a hip operation, the family needs money right away, and this is no lump sum vehicle. This is just an income vehicle, right?
Correct. It's designed for income. The cash flows are based on income, but trying to acknowledge that it's likely to happen. In the 10-year period, in one of those 10 years, we'd capitalise the income payments for 1 year.
Okay, so you could do that.
But only once.
Only once. Okay, so there is this ability to take a lump sum which is equal to just 1 year, and then that gets adjusted. I guess at any stage they could also go to a reverse mortgage provider and replace the credit model for the debt model as well, potentially.
They could.
And just buy it out, get a lump sum if they had to, or sell the property.
Remember, they got to pay us out, then only get the residual. So if it was after 10 years and they used a debt model to take us out, they got to repay the 35 first.
Yeah. So
it's how much the bank will lend them over and above 35.
I see. Got it. Okay. So there's some definite considerations. So people that are thinking about this probably need to do a little bit of research, ideally sit down with an advisor or a family member, a solicitor, and actually model out what the next 10 to 100 years is. Okay.
100%.
Okay. So what else do people need to know about this? And I'm thinking about the kids, because more than likely the people listening to this might be people who have parents. Like I know the demographics fairly well who listens to this podcast, and most people would be probably below the age of 65.
Yes.
But there'd be a small amount that definitely are retired. That might be the target market, but probably the kids. How can kids pitch this idea effectively to their parents if the kids believe that this is actually a valid solution? Thinking that the kids are probably in their like 50s and 60s, by the way, right? So we're not talking about children. We're talking about adults who are worried about their parents running out of money, and they know their parents are worried about it. How can they actually position this effectively?
Go back to the first example, the very first house we did down in Christchurch. And I suspect there are a number like this. That the family were worried. They could see that income was offset by expenses, and there was very little for the gentleman living in the house because his wife was at home. So there was a genuine need. It really wasn't a choice. Something had to happen. And this enabled the homeowner to retain dignity and live in the same house and not have to downsize, and find a sensible way to meet those completely unknown health expenses that are so prevalent in retirement. So this one was clearly driven by the family, who, yes, were in their 50s, and they were, if you will, shopping for a solution.
It will probably come from people in their lives who are worried about them more so than the retirees themselves at a certain point, right? with your existing funds that you're managing, are you allocating towards this as well? Is there a bleed over? Okay, so there is.
Totally believe it. We're managing just over $1 billion now, 1.1 billion. And one of our funds, which is about 120 million, over the next 7 years, it'll own about 7% of its portfolio in residential property.
Okay. And so will this be a typical growth portfolio, 80-20?
It's balanced.
So it'll be a balanced 60-40 portfolio.
60-40.
And so with this 7%, where does it come from? So it's kind of in between equity and debt.
And man, has that been a topic of discussion.
Yeah.
The investment committee's got some really good people on it, have decided that it has to be treated like an equity. So the 60 would effectively become 53 equity, 7% residential property.
Okay. So that's going to be really interesting, isn't it? Because I guess if there were investors who want to participate more in the broader group of options within the company, you have a really good component. It's an alternative asset class, basically, right?
Yeah.
It's very liquid-ish, but it's sound, right? As long as we have continuing property prices at the rate of 5 to 7% on average,
sound
for the next 30 odd years, we're going to be okay.
Exactly.
Yeah. And if we don't, I think we probably have bigger problems, to be honest.
That's the truth. There's a housing.
Yeah. Especially in New Zealand, we have problems with that. Yeah. Okay. So where can people go if they want to learn more about this?
Probably website's the best place, lifetimeincome.co.nz.
Yeah.
And look at the options there, both the drawdown options for their capital and the new lifetime home options. There are calculators there that help people. And Chelsea's developed a great Q&A on Lifetime Home, so people can see the questions other people have asked and our answers.
Good.
I'd start there.
Yeah, good. Excellent. Well, thank you very much, Ralph, for coming in today. It was good to catch up with you again.
You too, Darcy. Thank you very much.
Cheers.
Thanks for tuning in to the Everyday Investor Podcast. If you enjoyed what you heard and you want more, check out the Everyday Investor with Darcy and Garrow on YouTube. Follow me on all the socials and check out some of the online courses, sign up to the free fortnightly newsletter, and more. All the links are right there in the show notes. As I leave you, remember, some investments or strategies discussed here may result in financial loss. Always do your own research and seek qualified advice if you can before making any investment decisions. See you next week.